Hello, welcome to this webinar. My name is Isaac Cmstrader, and I will be giving you a tutorial today on how to do some chart technical analysis. Really quickly, you guys can hear me? If you can hear me, please maybe type in your chat box yes, so I know that the audio is working. Okay, great. I see some yeses here. Great. Okay. Just to give you a quick background of myself, I started trading in 1998 during the dot-com boom that everybody knows. I started as a day trader and slowly evolved into trading everything from currencies, commodities, futures, options, ETFs, and so on. I traded for some Wall Street firms. One of the firms I traded for was actually doing 10% of the volume of the exchange on a daily basis, so they were pretty large. And currently, I'm actively trading some private accounts and my own capital. Okay, I guess we're going to start speaking about some chart technical analysis today. First of all, what I'd like to talk about is what is a chart. A chart, by the way, just to mention here, towards the end of the seminar, of the webinar, I will be taking some questions, so maybe somewhere between 5 to 10 minutes towards the end, you guys could ask me some questions and I will do the best to answer them. Okay. So, what is a chart? Basically, a chart is price actions of the market. What a chart will do is will give you a little historical view of what has happened in the markets, and well, sometimes we try with the charts we try to figure out what will be forward-looking. You have different types of charts. You have candlestick charts, which is what we're looking at here on my screen. Okay, basically a candlestick chart. If you see the green chart, the green candle. Okay, it's got the body and the wick. What the wick? Let me see if I can just make this a little bit larger for you guys so that you can see it clearer. Okay. What does this mean basically? Basically this means that this is the trading range where it traded throughout the, we're looking at a 5-minute, this is a 5-minute candle where it traded throughout that 5-minute period. The wick, which is the thin part of the candle, is where it has traded but with light volume. So obviously, well, not obviously, but the green candles are upticks, meaning they closed higher. That's their closing price. Their opening price is usually lower. And a red candle would mean that the opening price opened up here and a closing price lower, and that's why it's a red candle. Now, it's very important when you are looking at your charts or trying to do your technical analysis to understand that every time frame is very crucial, because you may feel that something is going higher or going lower. Depending on your time frame, that may not be true. Because, for example, let's look at the euro-US dollar. If we bring up a daily chart, no, let's go out a little bit more. There we go. If you bring out a daily chart, you will notice that we are really in a downtrend throughout. Let's see, we have at the bottom here, every time you place your cursor, you see the different dates. So 2014, okay, 2015. So ever since 2014, April, around April 2014, the Euro-US dollar cross has been downtrending. So, and ever since 2015 till today, basically, it's been sideways action. So now, this is a downtrend. But if you took the same euro-dollar and you went on a shorter time frame, let's say a 15-minute. Let's just take this. Let's take this time period, for example. Okay, someone can tell you that this is a uptrend. So everything is really true. All assets, all commodities, all currencies, all stocks, they all go up and down. Nothing goes up or down in a straight line. But during the time periods, and this is why it's very important, the time intervals, when you're picking your trades, during that time periods, you may have uptrends and downtrends. So when picking your trades, it's very important for you guys to look at the different time frames in order to get into a trade. When I put on trades, for example, I may look at the 1 minute to get a close picture. Actually, the way I do it is I start out looking on a daily. I like to see the last, 1 year, basically. What's my asset doing? Are we going higher? Are we going lower? What are we doing? And then, depending on the trade that I'm putting on, whether it's going to be a swing trade, a quick day trade, whatever it may be, I would be looking at a closer interval, time interval. So I like to look at a daily and see, for example, the euro, there is not much action. There's actually, I would say, a range bound of 116, which you will see the prices on your right side, okay, and the lower end of around $1.06, which you'll also see the prices on your right side. So in this range, this is a range bound asset. I would be looking to sell near the highs and looking to buy near the lows until the market breaks one way or the other and tells me that now we're going the other way. So how is a chart formed? What is this really, telling us? What is it? What is the story behind a chart? Well, the charts are, like I mentioned, they're price action of traders, hedge funds, banks, buying and selling for a reason. Everyone's got a reason. The smaller guys like us would be mostly doing technical analysis, which is what we're speaking of today, and not worry about fundamental analysis, which that is actually the effect of news pieces, data, information. The big banks who usually have that data and that information, what happens is, how does the chart tell us a story? When you see something, when you see a move happening, whether it's breaking up or breaking down, without any true rhyme or reason to it, but the action is all of a sudden starting to sell off, and you know that somebody with a lot of information has some information out there, and what they do is they act on that information. So a lot of times you'll see a move, just like, for example, here, where the market starts to break down. You look around, there's no major news, and it keeps going lower and lower, and then news breaks, and that's when it's kind of too late for the move because somebody already knew that. How do we use that to our advantage? What we do is by using technical analysis, is we just follow the chart. Basically, if the chart tells us we're going lower, we don't argue that. We go lower with the chart. Or if the chart tells us that we're going higher, there is no arguing there. We just buy with the markets. And this is because, again, we do not know information. All we do is technical analysis, and that's how we try to make a living, or grow our accounts. All right, and now let's look at some. I'm trying to find some popular chart patterns that could help us identify moves that are happening in the markets. I'm going to switch over to some crude oil. By the way, this platform is, I got to tell you, for beginners or even intermediate guys, this is an amazing platform. It's probably amazing also for people who've been trading for a while. It's very simple to use. If you notice over here on the side, I have my all of the different assets, and all I did was click on the asset and the chart comes right up. I have here my order button where I could sell and buy at the market immediately, which is a great thing. When you want to get in or you want to get out of the market, you just do it. You don't ask questions. And also I have here where I can place my order, my limit orders, my stop orders. I'll get into that a bit later. So now, let's see the crude oil. Let's see, what are we looking at? Okay. Let me break it down. So the crude oil, let's see, let's start by, crude oil has been also downtrending for quite some time, okay, since the year 2014, from 106 all the way down to $28 in 2016 recently. Now, recent price action of the last year and a half or so, it's kind of sideways, kind of been sideways. So one simple chart pattern that is very, very common, and many traders, and whether big or small, use it to potentially put on a profitable trade, would be let's say this double top here, this top right here, and this top right here. Let me see if I can bring up a drawing pen that I can highlight it to you guys. All right, so we have this top right here, and we got this top right here. Now this is what's called a double top. Okay? Now usually a double top should do a pullback, as it's currently doing right now in the market. So the type of trade you would put here is I would sell the market right around here, wait to see if this market points back down to take my profit, and if I'm wrong, let me see, let me just go back, see if I can bring this lower. Okay, 1 second. And if I'm wrong, I would put my stop loss right around here somewhere. which would be the high outside of this high and outside of this high. So you define your risk reward. You know where your risk is. You know, you sell it at 51.45, 51.50. I'm getting my prices off. You can actually, let's see. Here's our, there we go. This is when you put the cursor right over the candle, you see the high of 51.66. If you can see that, let me see if I can mark that for you, where the highs and lows are. Okay. Now, this is the high. That's not showing it. Okay. See that high of the candle, 51.66. Let's go to the following candle next to it, 51.61. Okay. Now, if we went to this candle right here, our high is 51.59. So basically, right around the same price, you would put your market short at around 51.55 maybe. You know, your risk is about 10 cents, 15 cents, and you're hopefully trying to make maybe $2, you know, looking for it to come back. Maybe if you're swing trading it somewhere around support, which is around $43. So basically, you can have, what you're looking for is situations where you have nice returns versus your risk. One moment, please. Okay. Now, this is the daily, and this is the chart pattern I spoke of. Let me see. I just want to clear that up. Okay. This is the chart pattern I spoke of, which is very, very common. Double tops. Okay. And that's on a daily. Now, if you took that in a shorter time period, for example, a 30-minute, it's no longer the same chart pattern. Now now you break down the trade to a different trade, and that's why it's very, very important for you to realize what kind of trade you're putting on. Are you planning to put on a swing trade, or are you planning to put on a fast money day trade? These are all things that make every single trade, whether a profitable trade or a losing trade. Okay. Let's go now. Let me try to get another chart pattern for you guys that is a common chart pattern. Let's move. Let me see if I will just move. This is actually a W formation now on a weekly. On a weekly, this kind of looks like a W formation. And what this means is that if we break out through here, through this level right here, okay, this market is going to take off. But what is a weekly chart? A weekly chart means that every single one of these bars that you're looking at, the candlestick, every one of those sticks, is a week. So this is a week's worth of trading. Okay, it's a little bit different, really longer term swing trading, and it takes a lot of patience. But this is a week trading. Let me try to find a different asset where I can find some more interesting patterns. Okay, you see me, I'm going through these different assets right here on the side. which are very, very convenient and comfortable to trade off. So here we go, British pound, US dollar. Now that one, as we all know in the news, has been getting hammered lately since the Brexit decision. If we look at a daily, I mean, you know, look at this candle right here. Okay, and let's see. So let me see. Here's an example of we just had the other day a flash crash where, I mean, the market, look at that wick. Look at that thin wick. It traded all the way down to $1.17 and closed at $1.24 for the day. I mean, that's some serious action on this assets. Okay. All right. Another example. Just like we had a double top. This here. Let me highlight it again. This here would be basically a double bottom, even though it's violated. Okay. It has violated throughout the day trading. You see that wick? On a 30-minute though, a 30-minute candle, it's kind of build a double bottom, which in return we had an explosion up. So the same way as I was showing you before, you know, the market came down pretty hard, kind of started settling in. Okay, went to test the bottom again, and when you test the bottom, it basically means that when the bottom has not broken here, it's very basic that either the selling has been exhausted or the buying has been pretty strong here. So either way, you're looking at stronger buying than selling, which created this double bottom here, and then drove everybody back into the markets, take the market right back up to the top. So you would do the same way. You would buy it here with a stop. Actually, you would have to wait on this one on a 30 minutes. You would stop out at this low, so your risk might be a little bit larger. As the low says 120 spot 88.4. If you can see on the top of the screen right here where we show the low. Okay, 120.88.4 versus these lows, okay, which were actually 121.083. And so that was your risk. And if you got in and let it ride, you're looking, you know, there was no reason to get out of this trade until somewhere around here where it broke the last high candle. So you would probably get out around here somewhere, which I would say the high is 122.8. You know, the low is 122.4. It's another great pattern that usually works if you find them correctly. All right, let's see what else we can find. By the way, this platform, as I mentioned in the past, you know, you want to get into a trade, you see a trade that's interesting, you just put the value, the dollar value that you're interested in being in the trade, whether it's $3,000 worth, $4,000, whatever it might be, and as soon as you hit the button, it will execute. I think I'm going to give you a demonstration, a quick demonstration of how this works. Um, let's see. Just to demonstrate, doesn't mean that actually it's going lower, so I wouldn't be a buyer here, but just to demonstrate what we're doing. So I hit the buy button. It tells me that my order has been executed at the price of 122.245. Okay. And if you look down here where it says open positions, like I said, I shouldn't have bought this market, but that's okay. This is for demonstration only. And here is our position. So we bought $4,000 worth of British pound, US dollar. This is your instrument. Okay. This is your opening rate. This is the price that we bought it for. You have your time here. Now we could set a stop loss by just clicking on there. Okay. So let's say we don't want to lose more than, let's just say $10. We can go here, set it up, and put in our stop. Okay, so here's our stop. Okay, and also we have a take profit where I could click this one and say, all right, you know what, if I'm right, I'm trying to make, you know, let's change the numbers so it's easier. I'm trying to make $25, let's say. Okay. So, sorry. Okay, just for arguments, just for purposes of this example, I put it in for $20. I put in my take profit. This will sell it there. I put in my stop loss, which will prevent me from losing any further, because I'm not interested in losing more than $10 in this trade. And I hit update. And now my order has been updated. So now I have, if you click here on the pending orders, where's my orders? Oh, sorry, they're here. Now my orders are out there. Now, if you wanted to, another great thing about this specific system, where we can just close our trades right here. Okay, we could just hit close and that will close the trade immediately. Okay, order close just like that. And if we had more than one order, we can hit this button here which says close all. All right. Let's see what other patterns we can find that maybe, let me just clear this up 1 second, please. All right. Let's look at gold. Gold is another one of my favorite ones. Another clue to different chart reading is you see this top here in gold. Gold has been rallying from 2016. Gold's been rallying a lot longer than that, actually. Yes, from the beginning of 2015 has been rallying. And somewhere around July has hit a top, hit a wall here. Okay, so gold rallied, hit a nice little wall. See this? Nice little wall here. Pull back, try to rally again. You can call that basically a double top, even though it almost couldn't even reach the prior tops. Again, same type of trade. You put your short out here with a stop right above these levels. Had you done that correctly, you see the results. Market just turned right over. and that will be an amazing trade actually. That will be an absolutely amazing trade. Let me try to find a different formation for you guys so we can discuss some other chart patterns. Okay, actually I think in the 1 hour there's a nice formation. No, sorry, in the daily element. Okay, this breakout of gold, this mini breakout after a rally. Whenever you have a rally in the markets or a sell-off in markets, then you have what's called a flag formation, a bull flag, or you can have a bear flag. Now a bull, for those that don't know, is when the market is looking to go higher, and the bear market, and a bear flag or a bear is when the market's looking to go lower. So from here to here, okay, the market rallied nicely, topped out here, pull back, and now we take the bottom here, which is the bottom of the move after the rally, and it go all across the bottoms, almost like a perfect line. Okay, my drawing is not the best, but here's where you have a flag, a bull flag formation. And whenever you see a situation like this, when the market rallies, you get a little pullback, and then there's a consolidation period. You look for when we start breaking up above this bull flag. And once we broke out, basically right around anywhere from here to here, as long as we didn't break lows below the flag, okay, the market goes right up, and this is what happens, rally. Now this market actually came back to test the support level of this flag, and it held, and every time it held, rally again. So depending on the type of trader you are, depending on the type of trade you're putting on, if you were short-term trade, a few days, you'd get this move here. If you were a swing trader and you're testing support, you held, you get the bigger move here. Now the market actually did a little head fake over here, where it traded below support, where you would sell it here, but keep an eye on it because we still are in a bullish formation. And after they try to fake the market to the downside, couldn't do it, spiked back up. So this is a bull flag formation. Whenever you see a market that went up very nicely, pull back for consolidation, you can use your lines to draw and see that it is holding and creating a flag formation where it consolidates. What happens is actually in this consolidation period is the buying and the selling gets tighter and tighter and tighter until one side wins the other side. So obviously in this case the buying prevailed, the buying won, and we went higher. Okay, let's see if I can find some bearish formations for you and show you how it works with a bear flag too. Let's see. Okay. Well, not in this. I have to look for it in a asset that actually declined in the past year or so and not went higher. So crude is the one that comes to mind, of course. So let's just see if we can find a bearish flag in crude just to show that formation. No, doesn't look like there was any bear flags. This market what I wanted to bring out to you guys also is that these are great times to trade. And whenever people see the markets go down a lot, or you get a Brexit situation, or you get a British pound situation, people are scared of the markets and thinking I better not trade his markets. It's actually the opposite. For the trader, you are looking for volatility. You're looking for things to move up and down big in order to have price movement, so you can profit from it. So there's actually no fear in trading the markets. Of course, you must be cautious and careful of what you do. And like I showed you, you should be putting in your stops. I'm not sure if I showed you how to put a stop in here. Let's go to a pending order. Let's say we want to buy this. Here's our, okay, we'll go to the same scenario that we had in the past before, where we have this double top, and we're short. And if it takes out, like we said, the high of 51, what was the high we said? 51, here we go, 61, 66, this is the recent high, the highest point from that move. So what we do is we say we will buy stop to stop our loss, okay, at the price of 51. You've got to give it a little room to breathe. So 51, oops, what am I doing here? No, 1 second. Okay, 51, let's say 75. And like I said, you're putting your short out at around 51.55, maybe 60. You're risking 20 to 15 cents, okay? And then you obviously set in the amount that you had a position in, and you place your order, and that order is there. Now, if the market takes out the high, you get stopped out, and that's how you protect your capital. Very important as a trader to protect your capital. That's what you have to work with. Okay? I want to mention again about this platform. It's very crucial for any trader, for that matter, whether beginner or intermediate, that the tools that you're using are very accessible, very easy to work with. You don't have to learn a whole new, it's enough that you're learning about trading. You don't need to learn now, you don't need to get a PhD in trading. So this platform is amazing when it comes to placing orders, watching your positions here. On here you watch your close position. This is a close position put up before as a sample. Being able to close all your positions with one click on a button, very important. Sometimes you have more than 1 or 2 positions and some news just broke out and you may not have stops in, and you want to just say, hey, it's time for me to just, protect myself and close all of my, whether it's losses or profits, just close everything up. Now one button, one click of a button, and you close it all. It's all gone. Okay? It's very simple to move back and forth from different assets. You just click and you got your charts. You see what's going on. Very simple. You've got everything right by your hand. Your 1-minute chart, your 5 minutes, all the different intervals. Okay? You've got your, like I showed you, your opening of a candle. By the way, closing your low, your highs. Okay, you have your dates here. It's a great little platform here. You know, you even have here on the side what's called a social stream, where you can, if you happen to be watching other traders around the world who are trading different assets and you notice that they are good at what they're doing, you could potentially copy their trades. I believe that we can take a few questions right now, and I'll try to answer them as best as I can. So if you have some questions, please put them in. I'm going to read, I see I have some questions on here already. I'm going to read through some of them and see what I can answer. Okay, so somebody's asking here a question. Thomas, since one can find several technical patterns in the market for a commodity, how to know really which one to rely on? Okay, that's a great question. The truth of the matter is you never know which one you can rely or you can't rely. All you know is that these patterns, they work and they don't work. And this is why I went over protecting yourself and putting your stops in. It's very, very crucial that you make sure that you have stops in. So if you identified a nice pattern that you've seen in the past and has worked a few times, you have to make sure that you put a stop in, because obviously these patterns, they turn, they switch. I mean, that's how we get a move from a bear market to a bull market, or a bear trend to a bull trend, because things have changed, you know. Somebody decided to sell and they're done selling, and there's no more selling going on, and now new buyers stepped in. Everything changes. So whenever there's a change, that's when the pattern no longer works, because, well, obviously something has changed. And this is why you need to protect yourself, and you have to put a stop. So when you put a stop, you know what you're risking, and you know what you could potentially earn. I hope I answered that question for you. So let's see. Great. Okay, so I do believe there will be a copy, Connor, I do believe there will be a copy of this webinar online for you guys, that you can review some of the information that I gave you today. If you need to find out, I think that you can ask, or maybe someone can send you an email. Yes, so Thomas, one more question here. You are asking basically about the shorter you trade, the smaller candlestick pattern to follow. Not sure I understand the question 100%, but no, it's not necessarily your shorter time frame that the smaller candlestick pattern to follow. No, not necessarily true. You could have large candlesticks and still in a short time frame. The time frame really is there for you to analyze your trade, whether if you're willing to swing this trade and giving it a little bit more room to fluctuate, or are you going to be tighter with your stops and follow a shorter term interval. So, you know, if you're trading a 5-minute trade, you may not want to give it too much time. You know, you're looking at the recent 5 minutes. So basically, if we go back to, again, to the 5 minutes, okay, this is a 5-minute. Let's just go to crude for one more time. Now this is 5 minutes, for example. Crude here, I believe there was a number today. The number came in bearish, and crude came right in. Okay, now imagine you were, you know, okay, I'm going to short a bounce in the 5-minute interval. Well, you don't want to give it all the way up to here, because it's not a, you're not protecting yourself. It's not the correct trade. Now, if you were going to trade this on a daily, that would be just fine, because guess what? You're still, your top is here. You know, you're shorted here. That's fine. You got to wait, a few more days. It may come down back to here. But when you're trading it in a 5-minute, then, you got to define your risk. You got to know where, maybe this is the support right here that we broke, but we broke right through it. You got to define your risk. You cannot, just because it's short-term trading, the candles, the long candle, the smaller candles really it's just a candle to follow. No matter what you do, you always have to protect yourself. That's the most important, at least in my book. That's the key to successful trading. So Rob is asking me if I use moving averages, and so which ones and which time frames. Yes, thanks, Rob. I actually do use moving averages. I use personally a 20. I believe I use a 20-day moving averages. Yeah, you can put that in here. They have all the indicators here, which is here's your period. Okay, so you can put in a 20. Okay, and let's say we're going to leave it in red. So here's your 20-day moving average. You can add more moving averages. I like to use 20, 50. Let's change the color on it. Let's go to yellow on the 50, so we know the difference between the 20 and the 50. And let's see. And I also use the 200-day. That's just me. Everyone does what they like and what they figure works for them. So here we go, the 200 in blue. So now even the moving averages on different time frames mean a whole lot of difference. So for example, on the daily, the 200-day moving average is back at $42. Meanwhile, if you're looking at a 5-minute trade, your 200-day moving average is at $49.95. So yes, these moving averages are basically, they're a formulation of obviously price action, of trades that have went on and off, and they do work because usually the bulk of the trades, which is obviously the biggest players in the markets, are eventually going to come back to their prices, and that's where you get the moving averages, which is, again, it's the bulk of the trading happening, whether it's 200, 20, or 50. So I do follow moving averages, but again, nothing is, I would say everything works, and I would say nothing works. It all depends on how you apply your moving averages, your risk, reward. Sorry, I'm just looking at another question here. Again, yes, they definitely are a helpful tool. You do have, by the way, all the different indicators here, and there are tens of them. Bollinger Bands, MACDs, money flows. There's no end to different indicators that you can choose, or you may, everyone, I know many people choosing different types of indicators. And like I said, they all work, and they all may not work. It all depends on how you apply. Okay, I guess I'll take one more question. Let me just see. It's not the so somebody was asking again about some technical indicators and analysis tools. So it's all up here. We have here, by the way, we can also switch, of course, from candlesticks, which I personally like, to bars. This is also a very good type of charting. You also have the lines, which line is a little bit more, it doesn't tell you too much information like opening and closing of a candle. It more kind of gives you a trend. You can kind of like plainly see the trend happening. So for example, let's Let's see here, you can clearly see it's a downtrend without too much of candles up and downs. Or here again, another downtrend. So you do have these different options here in this platform. What else we've got? And again, the indicators are all here. You've got some more indicators here. You can also enlarge the screen so you can see your charts better with one click, which is, again, it's amazing to have everything just so simple, so you can move around quickly, especially markets are moving quick. It's very important to be able to move quickly in and out, see what's happening, know the big picture, because you're making decisions here with real money, your capital. Okay, you can change the languages here. You can take a tour. And that's pretty much it. I thank you all for joining us today. And I hope that this webinar was helpful. Good luck trading, and hope to see you in the future.